Hi, my name is Darren from HCJ.tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. And today we have the honor and privilege of speaking with George. George, can you please introduce yourself?
Thank you, Darren. My name is George Dimov. I'm a certified public accountant, and I have a team of 14 senior professionals. And what we do is the same type of thing: demystify taxes as much as possible, and with a focus in international and typically complex situations.
Fantastic.
Now, let's talk about the individuals, the families who may be doing business or maybe working as US expats. They're exposed to obviously the US tax system, but also other jurisdictions as well. Could you talk just generally about the importance of preventing double tax and how do you do that? How would you go about that from a strategic point of view?
That's a great question. And this is something that I think everybody should use. And I've seen cases where it didn't get used and people just paid more tax than they should have. The United States right now, and you said it earlier in our conversation, where there's something like 2 million Americans, North Americans from the United States living in Mexico. And there are millions of United States citizens, okay, that are living in other countries. And the first line of defense you have against double taxation is something called the Foreign Earned Income Exclusion. Okay, it's reported on Form 2555, and it excludes up to $120,000, $130,000 worth of income each year. Okay, so that means the first 120,000 or so of income that you earned in this foreign country, and you could take a look at it even on the forms on the 2555. It's just simply excluded. Now, the rest of it is really interesting. The rest of it is on paper taxed at that next tax bracket that it would have been even if the first 120 wasn't excluded. Okay, which I've seen that because people have asked me that in the past. It doesn't start at your first tax bracket; it starts at wherever you left off. But there's a secondary protection there, which is called the foreign, the foreign tax credit. Okay, and that's on Form 1116. Okay, and that means that if you have some tax obligation in a foreign country, let's say you're in Germany, okay, oftentimes that tax obligation, many of the countries that our clients move to are these Western European countries that have a tax rate that's similar to or higher than the US. So, and this is a situation where, if you're going to pay more taxes in Germany than you would have in the United States, what you do is you report that on your foreign tax credit forms. And you can even get a carryover for this. So if you haven't used all of it, you can carry over in another year. I've seen also differences in how this works. For instance, we have many clients from banking coming in from Singapore. For whatever reason, I've just seen so many finance professionals coming from Singapore to the United States, or expats from the United States or other countries like the UK that also have US citizenship that have gotten jobs in Singapore and moved back and forth. And one thing I've noticed with them is it also happens with tech professionals there. When you receive restricted stock units or equity from an employer there, it is taxed at the value at the time of the grant, which is different than how this happens in the United States side. In the United States side, unless you file an 83B election, okay, you're taxed on equity as it vests. So that means in Singapore, for Singapore purposes, you're being taxed essentially on phantom income because this is income that you haven't even earned from your employer yet. You're earning it later. And I've seen situations where somebody paid a big tax bill in Singapore, then later moved to the United States. Well, they're still carrying over that credit. Okay, so that's an opportunity for you to be able to not pay on equity that's being vested and you're paying in the United States even once you come back. So I've seen this happen. So these are your two main forms, your 1116 and your 2555 for your foreign tax credit and your foreign earned income exclusion. Okay. There are other things you can do too. You have a housing exclusion. Okay. I believe it was something like $37,000 at the most, but there's some exceptions where you might be able to go higher. Okay. So but those are the main things you can do to protect yourself from double taxation. Also, there's dual tax treaties between different countries. This is something that before the show started, Darren and I were talking about this, where sometimes, and I see this with my team and with client situations all the time, sometimes when you're looking at the dual tax treaty, there is not going to be specific instructions in there where it says on form XYZ on line so-and-so, you put this, and all your problems go away. There's no such thing. And we have many clients that are specifically in financial services and engineering that are very detail oriented. I mean, that's their job and that's their whole personality, is to be detailed oriented and to read every line and check every number and double check and triple check. Okay. And that's why they're so successful what they are. And they try to attempt to do that in tax, and they'll very quickly hit brick walls when it comes to the foreign tax treaties, because many of them just maybe have two paragraphs. And then how do you take those two paragraphs and put them in the forms? Okay,
Yeah.
the forms will tell you, okay, per this tax treaty, okay, some of them are pre-planned. Very common ones we see are with students coming in from India or China. You know, the Chinese ones, I believe, had an automatic $5,000 deduction. Okay, so some of them are very predefined or already in most professional tax preparation software, but others, okay, you might have others where you just really need to think and go into some gray areas and just do the best you can with the information you have. So I always tell our clients, take the easiest route first. Take the path of least resistance. Don't start getting bogged down in the foreign tax treaty. Okay, I see some clients sometimes approach me and they're saying, "I'm working and living here, a foreign tax treaty," and I say, "Oh gosh, they're already going in the most complex possible way, most complex possible route. Just use the foreign earned income exclusion. The IRS sees it all the time. It has a low audit rate. Just use your foreign tax credit. The IRS sees it all the time. Unless you have some crazy numbers in there, you have a low audit rate. Just use the easiest thing. Don't reinvent the wheel here." But we have some clients that insist, and you know what? If they want to pay for an appointment, pay for the accounting services to do the more complicated thing because that's what they prefer, we'll do it as long as we think that it's legal and it's fine. But we always advise clients, look, please make things easy for yourself, make things inexpensive for yourself from a compliance standpoint. In other words, how much you have to pay somebody like Darren or myself to do it, and take the easiest road first. And I'm sure Darren agrees with something and has seen that too.
Yeah, absolutely. Thank you for that. George, if someone wants to get in touch with you, what's the best way to do that?
My website is a great way. You can go on our website, which is Dimov Tax. It's my last name. That's EIMOV tax.com. Or you can send an email directly at info@dimovtax.com. Those are two great ways to get in touch with us. We also have a phone number. You can also call us. And the best phone number is 833-829-1120. That's +1 833-829-1120.
Fantastic. Thank you.